Hello, and welcome to the latest edition of Equital Conversations. I'm Gerald Ashley, and once again, I'm joined by my good friend and colleague, George Cooper. George, good morning.
Morning, Gerald. Good to talk again.
Indeed. You didn't ask how I am today, but you can probably tell I've got a little bit of a cold, so apologies to listeners if I sound overly husky, but hopefully I'll be all right. Now we have a slightly tongue-in-cheek title for this podcast today, and it alludes to a famous album that was launched almost exactly 48 years ago in October 77. And our take on this Sex Pistol album is to call it Never Mind the Benchmarks. Okay, this may only appeal to a few aging rockers listening to this, but it is the idea that what is going on with benchmarks? Are they too front and center of the investment community? And I think between us, we may come up with some thoughts that in some ways they may even be damaging. With that thought in mind, George, obviously people always think about passive investment versus active management. Do you want to give us a quick view of the landscape of this?
Yeah, I mean, first of all, I'll hold my hand up and admit that benchmarking has been a bit of a hobby horse for me for a couple of decades. It's been one of my sort of rants. I think benchmarking has gone too far, and I think it's doing things that are quite damaging to the economy in ways that people don't quite appreciate. And of course, first there was benchmarking, and then the move to extreme benchmarking, index tracking funds where there's no deviation at all, entirely passive management, in other words. I think this movement has undermined the purpose of the asset management or the investment management industry generally.
Has it turned out to be what looks like a clever shorthand for investment decisions, but once again with unexpected consequences?
Well, yes. I mean, first of all, I would say if you're going for a benchmark, if you give your fund manager a benchmark, in the process of giving the benchmark, what you're really doing is taking back the vast proportion of the risk onto yourself. It's your decision. Whatever the fund manager does, if they're active, there'll be a little bit of deviation. If they're passive, there'll be basically no deviation at all. And that means that you're the fund manager.
Yeah.
You've made the investment decision. Now, that's fine in a lot of cases, but often when you make that decision, you might have a good reason for doing it now, but often you leave your investment in the fund for years. The world changes, and you never really revisit that investment decision. So that's just a sort of caveat. When you're buying an index fund or a benchmark fund, you're not really paying for fund management. You're paying for investment execution, if you like. You're paying for implementation rather than management.
Yeah. And as you say, the world constantly moves, and you can be left hugging a benchmark that is drifting away from, dare one say, market reality.
Yeah. So I mean, before we started the call, I put a few different benchmarks on one of my Bloomberg charts, and just by way of reference, another thing that with benchmarking is, people say, well, active managers tend to underperform their benchmarks, so don't use active managers. That's fair, but what you're doing in that process is you're not saying which benchmark to use. So you say, just go passive, go to a benchmark, but then which benchmark? People forget that there's thousands.
So you feel that you've outsourced the decision, but you haven't really, because you've still got to make that call on which benchmark or index or whatever to use. You did send me that graph, and I think we'll stick it in the show notes because it is quite instructive as to the difference in returns depending on which benchmark you use.
Yeah, so I mean, just to give an idea of how important it is, if we go back over, say, a 20-year period, so we start in 2004, if you'd picked an S&P 500 benchmark, your money would have grown about ninefold. So you'd have done quite well. But if you'd picked, say, the FTSE benchmark, which a lot of people in the UK do, your money would have only just tripled, which is actually a pretty poor return over a 20-year period. Now, the other thing that you've got to remember is, if we go back 20 years, put yourself in the shoes of somebody 20 years ago, think, well, what would the logical decision be there? Perhaps you would have said, maybe you had great foresight and you would have said, well, China's going to be the great success story. China's going to outgrow every other economy in the world, which it pretty much has done. Well, for the first about 12 years of that period, China would have outperformed the S&P, but still pretty mediocre returns. It's only, strangely, in about the last decade that the S&P's really started to outshine. And that's in a time when China is still growing and becoming more economically important. So you've got a lot of challenges in picking those benchmarks, because even if you get the right economy, you might not get the right market result.
So I could either at the professional level or as an individual, I'm forced into making some form of choice. I suppose some people would go for a sort of weighted so-called world index,
Yeah.
which may help in that situation. But nevertheless, I suppose lurking in the background, there's also currency. Depending on what your home currency is, that's going to have an impact as well.
Yeah, and so it's going to be very different from different perspectives. If you're in a weak currency, then world equities are going to look good for you. If you're in a stronger currency, they'll look less good. But to be honest, though, my big gripe with benchmarks is not really so much the equity benchmarks and what they do for investor returns. It's more what benchmarking does to the economy.
Right.
And I think benchmarking actually I think it's making financial markets more volatile, which is bad for investors, but it's also bad for the economy. But of course, nobody notices this, because if you're measuring against the benchmark and the benchmark's more volatile, big deal. You're marking your own homework. So that's one aspect. But the other one, which is again something that I think nobody really thinks about, there's a relatively small amount of money managed against equity benchmarks. There's a huge amount of money managed against bond benchmarks.
Yes, press coverage is always about individuals in trackers and equity tracking and all the rest of it. But in terms of scale, the bond market's far, far bigger.
Yeah, the bond market's far, far bigger. Now, if you had invested in one of the higher risk, and therefore it should have been one of the higher return bond benchmarks, which is the long-dated US Treasury benchmark, and you'd gone in for something like what's called the TLT fund, the 20-year plus US Treasury fund, in 20 years you would have barely doubled your money, which is a pretty terrible result.
Pretty poor.
It is, and you think about what you're doing if you're buying the bond benchmark. When you're buying an equity benchmark, at least generally, the benchmark is spreading your money out according to the market cap weighting of the equities. So you put more money into bigger companies than smaller companies. They're bigger because they're more successful. So that's not unreasonable. You're weighting your capital according to the assessment the market is giving to the value of the firm. But if you're doing it with bonds, if you're going into a market cap weighted bond fund, what you're really doing is you're weighting your assets according to the amount of liabilities that a government or a company has got. So you're giving more money to the most profligate borrowers.
Which is quite extraordinary if you think about it, really. I mean, it's upending what the logic should be.
Yeah. And this is where I think this process is basically making my industry sort of suffer from dereliction of duty, because what collectively what the asset management industry should be doing is allocating capital efficiently in the economy. If you've got a profligate borrower or a company that's potentially in a market bubble, you should be looking at the future returns, and you should be withdrawing capital from the excessive borrowers or the companies that are on extreme overvaluations, and trying to, if you like, sort of clip the wings and reduce the amplitude of the swings. But once you start benchmarking, that doesn't happen. You effectively encourage more borrowing, and you pour fuel on the fire of a stock market bubble. So I think this is, as I say, it's destabilizing the economy. It's a very difficult thing to prove statistically, but my feeling is that since we've become more and more enthralled with benchmarks, I think the stock market has had a greater propensity to experience bubbles, and the volatility of asset markets has gone up, and the average return of asset markets has gone down. So I think that's really where the problems lie.
Yeah, that's quite a charge, actually, isn't it? And it's effectively turning everybody into a more sort of short-term horizon as well. Two elements that strike me in this, which are from a sort of psychology or behavioral finance angle, is, of course, by definition, they create herding. So nothing succeeds like success. So everybody piles into sort of concentrated around winners within the index. We're seeing that in an extraordinary degree in the United States at the moment with the so-called Magnificent Seven, maybe eight, depending where you cut the line. That's one element. And that there's also a psychological marketing trick going on here, which is relative returns versus absolute returns. So, the idea, well, bad luck, your fund dropped by 9%, but actually we did very well because the index dropped by 11. Well, I'm still down, and okay, in relative terms, that's okay. In absolute terms, it's a disaster. But as we know, there's a huge sort of dynamic in the way people judge things in terms of their earnings and their status and everything else. And we do it in relative terms. Am I better off than my neighbor? Is my brother-in-law doing better than me? All those sort of relative elements are addressed whilst ignoring the absolute return.
Yes. Again, it basically lets my industry sort of hide behind the benchmark and not really do the job that investors need doing. And by that I mean, whoever you are, whether you're a big institution or a little individual saving for your retirement or saving for your deposit on your house or whatever, what you need is for your investment to grow faster than inflation. If it's not growing faster than inflation, then your money's actually losing value. And when I say you need it to grow faster than inflation, I think inflation is systematically underreported for various different reasons. Maybe we'll do a podcast on that at some point. But if the official target is 2%, at the moment, most inflation around the world is running well above that, 3 or 4%. I think the real inflation for most people is probably closer to about 5%. So what you need is a decent margin above that to achieve investment success. And if you've achieved that, then it's job done. And I think this is much more what investment managers should be focused on. They should be focused on delivering returns above inflation so that you're growing your capital for your clients in real terms. And then the investors themselves should be looking at benchmarks and saying, well, how are you doing?
Yeah.
So I think they should give the manager the objective of right, beat inflation by a decent amount. Let's see how you do it, and let's see how that compares with other benchmarks and other approaches.
Now that's a very painful mandate to receive as an investment manager. I'd much rather say, look, I'll beat the S&P 500, and what I actually do is I go away and I create a fund that pretty much is the S&P 500 with a few bits on the side or different weightings where I think I'm just going to edge ahead of the index. And this so-called, what should we call it, index hugging, I still pick up a nice management fee for. So why should I want to do your inflation thing?
The reason the industry has evolved the way it has done is because it's much safer to say to your clients, right, give me a benchmark, and I'll do something pretty close to that. Whereas if you say, okay, what do you really need, and the client comes back and says, well, I need inflation plus about 7% actually, then you've got to do a lot more thinking as to how you can do that.
Now, there's been an interesting test this year, I think, in the equity markets of benchmarks and indexes. In the famous Trump tantrum in April caused equity markets to sell off very rapidly. I think most people involved in management got a little bit grayer after managing money through that period, and then it actually came back relatively quickly as Mr. Trump started rowing away from his initial pronouncements. But what is interesting to note is that people still seem to be willing to hang on to their index investments. So maybe it wasn't a prolonged enough shock for people to say, hang on a moment, what the hell are we doing?
Yeah, I don't think this is going to change. This is, as I say, I'm just reflecting that I think it does have adverse consequences for the economy. I think it's leading to more volatility, more bubbles, and because of course the governments then have to come out or come into the markets and start bailing out companies and economies after a bubble bursts, that then causes them to print more money. So I think over time it's also going to lead to more inflation. So it has a lot of knock-on effects. There's another aspect to it as well, which I think is kind of interesting. And Elon Musk has been banging on about this in the last couple of days. He's been criticizing the voting companies, which do the proxy voting on behalf of a lot of index funds. So Musk has been campaigning for his $1 trillion pay package and complaining that some of these funds are not voting for his $1 trillion pay package. Now, frankly, I don't think they should, but that's by the by. I think his criticism of having outsourced voting institutions voting on behalf of indexed funds or benchmarked funds, I think that's quite reasonable. Because if you think about what's going on, you've got a load of tracking funds that are saying to investors, look, we can keep the cost of managing your money very low because we don't need to have experts looking at the companies.
Right. So the fees are very much lower, et cetera, et cetera.
Yeah. So we've got nobody, they make a virtue of saying we've got nobody that knows anything about the companies you're invested in.
Yeah.
That then gives you a corporate governance problem because nobody's overseeing what the management is doing.
This is another disconnect in finance, and they're always worrying, aren't they? This is a disconnect between shareholders and the management, and one's reminded of the disconnect in the credit markets 20 years ago with all sorts of complex derivatives that basically disconnected lenders from borrowers, and there wasn't the same sort of oversight. Seems very similar.
Yeah, economists call it the principal agent problem. In other words, the principal is not getting the correct response from their agents, the management of the company. So what's now happened is a lot of firms now outsource the voting decisions
Yeah.
of the shares they hold to other companies who then vote on entirely non-economic grounds. And as Musk has pointed out, and I think quite rightly, the two big voting companies, especially in the US, have effectively been captured by the woke agenda and have started to vote for all sorts of things that are not economic in nature.
So you've got a very vocal activist minority that's suddenly very close to the controls of voting on behalf of very large blocks of shareholders.
Yeah. And they are asking companies to do things which cost money and hurt investment returns, which nobody has any oversight of, and nobody is able to measure, how much the returns are being impeded by, if you like. So what's happening is the decisions are being made that says the investors should be paying a certain amount of money, a certain amount of their returns should go to doing good for the environment or doing good for society.
Yeah.
How much? If the market should return 10%, should we be cutting those returns by 1%, 2%, 3%? We don't even know how much they're being cut by. And there's no oversight of that. So I think that's a big problem.
I'm kind of reminded of, one thinks of the huge flow of funds into ESG type funds, and now equally the political atmosphere has changed, and there's quite a flow out from them. Not only was it the political atmosphere, it was the fact that if you looked at non-ESG areas, did extremely well. And I know some people will, say shock horror, you shouldn't be investing in them, but certainly there was a period of time in the last 2 or 3 years, if you got into the oil companies, got into defense industry, dare one say tobacco and related areas, they massively outperformed ESG funds. And so there's a combination, maybe a little bit of politics and also investors voting with their feet and walking away from this. But I think your point is well made, that the overall structure is still in place, and there's this rightly named passive lump of shareholders who are passive in the sense that they have no say of how the management of the company works.
Yeah, and we don't know the cost of this. There's also a question of should the fund management industry really be the policeman of these decisions? Here, I think we get into another problem, because if a company's really, let's say a company is polluting. If it's polluting and causing significant damage to the environment, then really the government should be stepping in with legislation or additional taxation to pay for the cleanup, the remediation of that pollution.
Yeah.
If we pretend as an industry that we can police this by our voting response, it's creating a false idea. It's simply false.
Also, it's a bit open-ended, isn't it? Where do you? It's not just environmental stuff. It's maybe gender balance. It may be all sorts of other elements to the firm. And again, with very activist groups jumping up and down, if they get any sort of leverage over this voting, cannot be good for shareholders at all. So it's the usual problem. You can't serve two masters, can you? Really?
I think effectively by accepting this mantle, by the fund management industry accepting this idea that we can control these things, we're effectively letting government off the hook. There are certain things that should be regulated. We should recognize that they do cost money, and we should make a decision as to whether that money is worth spending. Is it worth paying a higher tax rate in order to clean up the environment, or is it not? If we leave it to my industry, frankly, I know a lot of people in the industry. I don't think that we are collectively the best moral policemen in the world.
Well, we've pulled out quite a few threads here in our half an hour of looking at this, and I think I'm drawn to your comment a few minutes ago when you say none of this is going away. We've got tracker funds, we've got indexation, benchmarks, all the rest of it. One last thought on this then, George. Is there, to use the common parlance, a tipping point where index funds become so big that they start to dislocate the rest of the stock market?
I think we're already there. I think, I look at what's going on in particularly the artificial intelligence infrastructure boom, the rate at which we're building data centers, the concentration of capital in the bigger companies that are building the data centers, and the fact that a lot of those companies are now using their own market cap in order to fund that building. So it's been called circular financing, where basically Nvidia can use its market cap to fund its own customers, which obviously then boosts its revenue, boosts its market cap again.
We've been here before. I know people always go on about the .com era. People nowadays say, oh, it's a bit different because these companies are profitable this time round. But last time round, we had huge misallocation of capital. The one that always comes to my mind is dark fiber. Everybody decided they needed to put glass fiber networks in everywhere. And at one stage, the capacity was about 10 times the demand. Now, you can reasonably argue that over the following years, that got absorbed and was used. But at the time, it was probably an investment mistake, or certainly far too early.
Yeah, I suspect we've got the same problem happening now in the data center boom. But part of what we've been talking about today is my industry, the investment management industry, is not policing that because they don't need to.
Yeah.
Because if you measure it against a benchmark and the benchmark says allocate capital to this, and the debt benchmarks say, hey, these guys want to borrow a lot of money, so therefore market cap weighted, you should give them more debt. You should fund that borrowing. It just all sort of runs on its merry way without supervision. So I think this is already happening. I think this is why we're getting, frankly, more bubbles and bigger bubbles over time.
Okay, well, that's I know we always try to end on an optimistic note. Depending where you sit in the market, that's either optimistic or pessimistic.
Funnily enough, I think for those that are willing to do the work, I think there's reason to see optimism in this, because I think what it's done is polarized the market. You've got a lot of the market that's now extremely overvalued, and a lot of the market that I think is extremely undervalued. In the office, we call this the bubble and the anti-bubble. So I think the opportunities are there.
So as ever, as you say, if you do the work, it's not all closed out. There are plenty of avenues going forward. Right, we've come to that part of the show where we do our book recommendations. Though you've warned me you're not going for a book, you're going for a film this time. As ever, I'll go first. It's a book from 2006, though it sounds and feels and reads as if it was written much more recently. It's called The Origin of Wealth by Eric D. Beinhocker. Beinhocker is a sort of consultant turned academic, and it's the subtitle or the strapline that explains what's going on with this book, and it's called Evolution, Complexity, and the Radical Remaking of Economics. I've had this book on my shelf for many years. I didn't buy it in 2006. I probably bought it 2 or 3 years later, but it's the first one I found was really good explanation of how complexity science is a way of thinking about markets and the economy, and it has some uncomfortable conclusions. Some things are just not predictable, and it may even be fruitless to try. And there will always be surprises, even in what look to be sort of stable conditions. So, as I say, The Origin of Wealth by Beinhocker, it's a bit of a tome. It's another one of these 400 or 500 page jobs, but it is a light read. It's not highly technical, no frightening mathematics, and so I recommend it.
Oh, very good. Incidentally, when it comes to huge economics books, I blame both Smith and Marx. I think they both tended to waffle horribly, and other economists have copied that. But anyway, that's another little rant. So as you said, I'm not going to go for a book this time. I'm going to go for a movie, and this is a 2011 movie with Amanda Seyfried and Justin Timberlake of all people, and the movie is called In Time, and this is one of my favorite sci-fi movies.
Ah, right.
And the reason I particularly like this one is because, being a bit obsessed with monetary systems, the movie is actually about another monetary system. In this movie, time is the system of money.
Ah.
Specifically, how much time you've got left to live.
Oh, it's another one of these before you get executed or disposed of or whatever. Yeah.
Yeah. So you're forced to keep earning in order to keep living. And of course, there's some people that there's some people in the movie that have so much time they're effectively immortal, and then a sort of underclass that are literally living paycheck to paycheck. And
they're sort of there's the guys who are sort of running up a down escalator, I guess, effectively.
Yeah. So the movie's entertaining, but the monetary system of time is also quite provocative. And what made me think about this movie again to recommend it today, of course, is the maid system in Canada now, which I will just leave it there. But I would say maybe we're starting to implement an element of what's in the movie. So I'd recommend people watch that.
Well, this prompts one final thought, is that maybe a podcast for the future, other than the one you mentioned earlier, talking about inflation, we should talk about the relationship between time and money, because they're two tend to be fixed sort of axes in people's minds, but of course in truth they're very fluid and all over the place. George, well, I think we gave a fairly good run round on benchmarks without being too much like aging punk rockers, and I think that will do us this time, and look forward to talking to you again. Thank you.
Okay. Until the next time, Gerald. Talk later.